The government just handed the banking industry a massive favor, and you definitely were not invited to celebrate. A few days ago, on June 25th, 2026, the FDIC quietly passed a rule that almost every major news network completely ignored. They reduced the fees that banks have to pay to keep your cash insured. I know, that sounds incredibly boring, but it is not. Hidden inside this dull regulatory update is a detail that should make any American with a checking or savings account sit straight up. The invisible safety net protecting your hard-earned money from a total wipeout was just weakened. And trust me, your bank is not going to send you a warning text. Your financial planner is not going to call you. No one is going to tell you about this. That is exactly why we are stepping in today. Welcome back, where we untangle the hidden moves that actually impact your wealth, your savings, and your future, without using complicated Wall Street jargon and without the corporate PR spin. If this is your first time watching, go ahead and hit subscribe and turn on those notifications. We track down stories exactly like this one long before the rest of the world even catches on. And if you have a friend, a spouse, a parent, or anyone who trusts an American bank with their money, do them a massive favor and send them this video right now. Okay, let us dive in. To really grasp what went down on June 25th, we have to rewind to a dark chapter in American history that most folks only know from high school textbooks. Imagine it is 1933. The Great Depression is ripping through the country like a tornado. Businesses are closing their doors. Unemployment is skyrocketing. And regular people, folks just like you and me, are rushing to their local banks in a state of pure panic, scrambling to withdraw whatever money they have left before the whole system breaks. Banks are collapsing everywhere. Families are watching their entire life savings vanish in a single afternoon. And it was not because they made foolish choices or gambled their money away. It was simply because the bank they trusted to hold their cash went bankrupt and dragged everything down with it. It was easily one of the bleakest financial periods in the history of the United States, but out of that chaos, the government made a solemn vow to the public. That vow turned into the FDIC, or the Federal Deposit Insurance Corporation. It was launched in 1933 with one specific goal in mind: to guarantee that the horrors of the Great Depression would never repeat themselves. They wanted to give everyday Americans a solid promise, a promise that stated, no matter what happens to your chosen bank, no matter how terribly it crashes, your cash is shielded. Your deposits are secure. The government is looking out for you. And for many decades, that promise stood strong. The FDIC grew into one of the most reliable pillars in the American financial world. When banks went under, and honestly, banks fail much more frequently than most people think, the FDIC stepped right in, paid back the depositors, and prevented the entire economy from spinning out of control. It was this hidden armor that most people never had to think about, simply because they never needed to. Your cash sat in the bank. The FDIC insured it up to $250,000, and that was the end of the story. It was easy, dependable, and safe. But here is the reality about wearing armor. It only protects you if it is thick enough to actually absorb the impact. And the decision made on June 25th, 2026, brings up a terrifying question. Is that armor being quietly thinned out while we are all distracted? So, what did the FDIC actually do? On June 25th, the Board of Directors gave the green light to a new proposed rule. In simple terms, they suggested altering the guidelines for how much cash banks are forced to contribute to the Deposit Insurance Fund. The Deposit Insurance Fund, often called the DIF, is basically the massive pool of money that guarantees the FDIC can keep its promise to you. Every single time a bank pays its required FDIC fees, those dollars go straight into this pool. And whenever a bank crashes and the customers need their money back, the cash is pulled right out of this fund. It is the vital financial cushion that keeps the entire banking machine running smoothly. Without a fully funded and healthy DIF, that government promise to secure your deposits is nothing more than empty words. This is exactly where the story gets alarming. The FDIC just proposed shrinking the fees that banks have to pay into this exact safety net. Smaller banks would watch their fees fall by 2 basis points, while the bigger banks would get a 1 basis point discount. Now, I can guess what is going through your head. Basis points, assessment fees. What does any of this actually mean for my wallet? That is the perfect question to be asking right now. Because at first glance, this just sounds like some boring government paperwork that has zero impact on your personal savings. But when you peel back the layers and look at the real-world consequences, the situation looks a lot more dangerous. Let us picture it like this. Think of the deposit insurance fund as the budget for your local fire department. Every bank across the country pays into it on a regular schedule, almost like paying taxes. They do this so that when a massive financial fire starts somewhere in the economy, there is plenty of cash ready to put out the flames and rescue the people trapped inside. Now picture your local city council deciding to slash the fire department's funding. They are not doing it because fires are suddenly less deadly. They are doing it just because the neighborhood has been relatively quiet lately, and they want to give local businesses a tax break. Sure, that might sound totally fine for a few months. But what is going to happen when a massive fire finally breaks out and the fire trucks do not have enough water to fight it? Who is going to suffer the consequences? It certainly will not be the businesses that saved a few bucks on their taxes. It will be the regular families whose houses are burning down. That exact scenario is playing out right in front of us with this new FDIC ruling. And unfortunately, there is another piece to this puzzle that makes the whole situation even worse. There is another layer to this situation that makes it even more alarming. It involves a massive alteration to the actual definition of what makes a bank small versus large in America. This single adjustment could completely rearrange how your funds are guarded moving forward. Let us break that down right now. So, we have gone over what the FDIC is and how this update shrinks the fees banks pay to the insurance fund. But we need to look at a detail that is arguably way more important than the fee reduction itself. Hidden deep inside this same June 25th ruling is a change that almost everyone will overlook. It centers on how the government defines a small community bank versus a major financial player. And this distinction impacts your safety more than you might realize. Right now, the current rules state that any bank managing $10 billion or less in assets is labeled a small institution. Anything above that $10 billion mark is considered a large institution. This category is not just a meaningless title. It completely dictates how much a bank has to pay in insurance fees, the level of intense government oversight they face, and how the FDIC measures their overall risk. Small operations and major corporations play by entirely different rules. They always have, and for a long time, that $10 billion mark was the hard line. But under this new proposal, the FDIC wants to push that boundary from $10 billion all the way up to $30 billion. That is a massive threefold jump overnight from just one decision. Think about what that means in the real world. Every financial institution in America sitting between $10 billion and $30 billion in assets, banks that are currently treated as large entities, forced to undergo tight scrutiny and pay top-tier fees, would suddenly be rebranded as small banks. They would slip into the discounted fee bracket. They would face far less government pressure. They would be treated as if they are smaller, safer, and less complicated than they actually are. Publicly, the FDIC is branding this as a needed update. They claim the old $10 billion limit is outdated, that the banking industry has grown significantly, and that changing the definitions just mirrors the current economic reality. If you read that headline quickly, it sounds perfectly logical. But if you pause and really analyze it, some incredibly unsettling questions start popping up. Think about the world we are living in right now in 2026. Interest rates are bouncing around wildly. Commercial property markets are facing severe strain. Thanks in part to the conflict with Iran, inflation has shot up to a 3-year record of 4.2%. On top of that, the Federal Reserve is already hinting that more rate hikes could drop later this year. This is anything but a peaceful, stable economic environment. We are looking at a market where risk is spiking across the entire banking sector. So, why would the FDIC choose this specific moment to pull back on the oversight of mid-sized regional banks? Why loosen the requirements precisely when our financial system requires maximum caution, not less? And here is another thought worth considering. The institutions getting the biggest break from this shift are not tiny, hometown banks supporting rural communities. They are substantial regional players holding 15, 20, or $25 billion in assets. These are heavyweight institutions in our financial system. They are loaded with massive real estate and business loans, and they handle cash for hundreds of thousands of everyday citizens. Many of these banks are already holding portfolios that carry massive danger in this current economy. Relabeling them as small operations does not magically erase their risk. It just means fewer eyes are watching them. This is exactly why we run this channel. Because when these adjustments happen silently, wrapped up in dense legal language that everyday citizens will never skim, the people who absorb the damage are ordinary depositors who had zero clue any of this was happening. People who trusted the safety nets and believed the rules were built to shield them. And honestly, they were built to shield you. But guidelines can be rewritten. And when they are rewritten to favor corporate executives over everyday families, someone has to shine a light on it. Let us look closely at the deposit insurance fund itself for a moment, because this is the real core of the entire issue. The FDIC is pointing to the recent expansion of this fund as their primary excuse to slash bank fees. Their logic is pretty simple. The pool of money has grown, the safety ratios look healthy, banks have been contributing diligently for years, so it makes sense to grant them a discount now that the cash reserves are in good shape. To be completely fair, the numbers do show that the fund is currently sitting above its mandatory minimum level. Ever since those emergency assessments were triggered by the collapses of Silicon Valley Bank and Signature Bank back in 2023, the reserves have been recovering. So, on paper, the government's explanation is not totally crazy. But here is the massive flaw in that line of thinking. This insurance fund isn't built for a sunny day. It is meant to protect us from tomorrow's sudden storms. It is a shield against unexpected financial disasters, crises that, by their very nature, you can never accurately predict or time. If you look back at the history of American banking, it is crowded with moments where regulators assumed things were quiet enough to drop their defenses, only to realize far too late that the peace was temporary and deep dangers were lurking right under the surface. Think back to 2006 and 2007, right before the global economic meltdown. Back then, both government agencies and major banks pointed to record profits and rock-solid balance sheets. Every single risk model showed bright green lights. Then 2008 hit like a freight train and destroyed every single comfortable assumption made during those peaceful years. The real question we need to confront today is whether we are repeating that exact same historic mistake, removing our safety barriers at the exact moment we should be reinforcing them. So, we have covered the core changes from June 25th. We looked at the lower insurance fees, and we explored how the boundary lines were shifted to turn large banks into small ones overnight. We are starting to see the real question. Is this a smart update to old rules, or is it a reckless lowering of our defenses during a fragile economic time? But I want to take our analysis a step further, because there is a third piece to this proposal that almost nobody is talking about, and it tells us something critical about where the entire American financial regulatory machine is heading. It is officially called the Resolution Readiness Adjustment, and that title alone should make you stop and think. Resolution Readiness. Let that phrase sink in. Resolution is just the fancy word government regulators use when a bank goes bankrupt and the state has to step in to clean up the wreckage. So, resolution readiness is basically the FDIC asking these institutions, how ready are you to collapse? Do you have your files sorted out? Is your data structured so we can easily take over your dead business when you drop? And here's the exact detail that left me completely stunned when I first read through the actual text. The FDIC is literally offering banks a financial payout, a discount on their insurance premiums, if they can prove they know how to handle their own bankruptcy. The federal agency that is meant to serve as the ultimate shield for your personal accounts is essentially telling the banking industry, get your collapse blueprints ready. Prove to us that you can fail in a neat and orderly way, and we will lower your insurance bill. On one hand, you could look at this as intelligent planning. If a bank does eventually go under, having organized data and accessible systems means the FDIC can clean up the mess faster and more efficiently, which ultimately saves the insurance fund a lot of cash. That is a fair argument, and it is worth acknowledging honestly. But on the other hand, and this is the perspective that I believe everyday Americans need to hear, this policy sends a very loud, very specific message about what the government is quietly bracing for. Regulators do not build elaborate, custom survival blueprints for widespread bank failures during times of genuine economic peace. They construct those frameworks because they are seriously worried that a wave of collapses could be headed our way. The resolution readiness adjustment isn't just a boring paperwork tweak. It is a warning signal. And we believe you have a right to understand exactly what that signal means for your savings. Let us look at the bigger picture for a second, because this June 25th decision did not happen in a vacuum. It is actually part of a much broader trend of quiet regulatory rollbacks that have been shifting the entire financial landscape over the last few months. Earlier this year, the Federal Reserve, the FDIC, and the OCC teamed up to propose a massive overhaul of bank capital rules, the specific framework that dictates exactly how much cash banks must keep on hand to absorb unexpected losses. That single proposal handed the banking system roughly $87.7 billion in capital relief. In plain English, banks are now allowed to carry a much smaller buffer against bad investments. On top of that, the FDIC removed what they called reputation risk from their evaluation process, meaning regulators can no longer pressure banks based on the types of clients or industries they do business with. Then we saw the passage of the Genius Act, which opened the gates for banks to dive into stablecoins and the cryptocurrency market, introducing a whole new level of volatility into traditional banking. And now we have the fee cuts, the shifting definitions of mid-size banks, and the failure planning rewards all landing at the exact same time. When you look at each of these updates completely on their own, the government provides a totally reasonable excuse. They use phrases like modernization, boosting efficiency, cutting red tape, and encouraging innovation. Those are the catchphrases designed for slick press releases and formal government hearings. But when you zoom out and look at all of these changes together, a clear pattern emerges. The walls protecting our money are being systematically taken down. The strict rules established right after the 2008 housing crash, guidelines explicitly written to stop another catastrophic economic meltdown, are being dismantled piece by piece, rule by rule, proposal by proposal. And the people who will actually bear the burden if things break are not the banks. High-level executives have shareholders, massive legal departments, powerful lobbyists, and plenty of ways to protect their wealth. The people who will suffer are regular depositors, small business owners trying to make payroll, retirees living off their life savings, and young families who just opened their first joint checking account believing the system had their back. I want to be completely transparent with you here. The FDIC is not some evil empire. The people making these choices are not sitting around plotting how to ruin your life. The FDIC Vice Chairman, Travis Hill, pointed out that the insurance fund has grown significantly, which is why they wanted to ease the financial load on banks. And he is right, the pool of money has rebounded since the banking scares of 2023. Those are factual points. But having good intentions and solid short-term data does not automatically guarantee safety when things eventually go wrong. That is the exact friction at the heart of this story. The ultimate question is never whether the system looks stable on a quiet day. The question is whether it will be strong enough to shield your family when the economy stops working. And with everything we are seeing right now, sticky inflation, global instability, a new Federal Reserve leader hinting at more rate hikes, and a fragile commercial real estate market, loosening these safeguards right now demands a lot more attention than it is currently getting. Let us tie all of this together, because now you can see exactly what went down on June 25th, 2026, and why it is a much bigger deal than the media is letting on. The FDIC cut the insurance fees for banks. They tripled the asset limit separating small banks from large ones, overnight lowering the regulatory heat on dozens of midsize institutions. And they rolled out a new reward system that gives banks a financial break just for keeping their bankruptcy plans in order. 3 massive adjustments in a single day, met with absolute silence from mainstream news outlets. But the actual numbers are only half the story. What truly matters is how you use this information to safeguard your own financial life. So, let us shift to some practical steps you can take right now as an individual holding cash in the banking system, because you deserve to make smart choices about your financial security. First, you absolutely must know your FDIC insurance limits. The standard protection tops out at $250,000 per depositor, per bank, for each account category. This means if your combined checking and savings balances at one institution go over $250,000, every dollar above that mark is completely exposed. If that bank collapses, that extra cash is not automatically protected. While the typical American might not carry that much cash in a single spot, this is a massive concern if you are running a small business, managing payroll, sitting on a home sale payout, or trying to protect a lifetime of retirement savings. Second, pay close attention to the financial health of your specific bank. They are not all playing the same safe game. Some operations are incredibly stable and run very conservative loan books. Others are highly vulnerable, overexposed to risky commercial real estate, or operating on razor-thin capital buffers in struggling markets. The FDIC actually lists this safety data on its website, and there are plenty of independent tools to check your bank's financial report card. We always tell our community to stay proactive. Just because a bank has a massive logo on a sports stadium or branches on every corner does not mean it is automatically safe. Do a little digging and know exactly who is guarding your money. Third, embrace diversification, not just with your stocks, but with your actual banks. If you are holding substantial cash, moving it across different FDIC-insured institutions is the easiest way to multiply your protection. Every new bank you use unlocks a fresh $250,000 safety net. This is not advanced financial planning. It is just common sense self-defense. And with the government quietly rolling back regulations, managing the things within your control is everything. Now, let us address the elephant in the room. Some of you might be wondering if we are overreacting here. Is this just routine government paperwork being blown out of proportion? That is a perfectly fair question, and skepticism is healthy. Here is the honest truth. The adjustments from June 25th are not going to trigger a market crash tomorrow morning. The insurance fund is not dry, and the banking sector is not collapsing as we speak. If it were that urgent, every station would be broadcasting it. But financial danger does not work like a light switch. It does not flip from perfectly safe to instantly broken. It grows slowly and silently through minor decisions that seem completely harmless on their own until they combine to fracture the foundation. That is exactly how the 2008 crash happened, and it is how nearly every financial collapse in history plays out. It is never one single catastrophic event. It is a slow buildup of relaxed rules during the good times that leaves the whole framework exposed when the weather turns bad. The fee discounts, the shifted asset definitions, the capital breaks, they are all part of that gradual buildup. And you need to look at it now, not after the damage is already done. You want to take action while you still have the power to ask questions and adjust your strategy. That is the whole reason we built this channel. This channel exists not to spark panic or tell you to hide cash under your bed, but to ensure you are never caught off guard by changes affecting your financial livelihood. Knowledge is your shield, awareness is your power, and you have a right to both. If this video shed some light on something you had not heard about, do us a quick favor. Leave a comment down below and let us know. Had you heard about this FDIC policy shift before today? We look through every single response, and it helps us figure out exactly what issues matter most to our community. And if you have anyone in your life who keeps cash in a bank account, which is basically everyone you know, please share this video with them right now. Do it today, not tomorrow. The people who desperately need to see this are usually the ones who will never search for it themselves. Hitting that share button could spark the most critical financial talk they have all year. Thank you for tuning in. Stay sharp, stay safe, and we will see you in the next video.